This is 𝗤𝗲𝗍 𝗘𝘀𝘁 with Pitranomics, and CPA named Mike Ray of Almika Group is going to talk about life insurance retirement plans called LERPs. The questions that I have for him, one, what are the methods that he recommends to fund the life insurance retirement plans? These are insurance vehicles that cost quite a bit. So where you get the money to pay for them is a strategy to be considered. If you're taking it from another investment, does it make sense in the long term? Maybe it always does, maybe it always doesn't. I don't know. That's why I'm going to ask. And then as a result of getting these life insurance retirement plans, I feel kind of funny just saying LERPs, but as a result of getting those, do they impact your other retirement plan distributions in any way? And what is their taxation status? What happens when you take a distribution or a payment? I'm not even sure what to call it, so we'll find that out as well. How does that affect your other cash flows? And what are the guidelines for how much of a benefit you can expect to qualify for? Because I don't believe you can just say, hey, I want a $15 million policy. I think it's based on something, health, projected income. I don't know. We'll find out together. And then what is the process to use these vehicles as cash to live on? So what exactly do you have to go through? How long does it take? Because that deals with cash management issues. And any other questions or comments that Mr. Ray feels that's important for someone to know about life insurance retirement plans. Now, I will ask, once Mr. Ray comes on and speaks about this, if you're interested in pursuing this type of plan, please get in touch with him and consider hiring him to obtain these or any other services. Hi, Mike. How are you?
I'm good. How are you doing?
This is Mr. Mike Ray of Almika or Almika, the first one or the second one?
Almika.
Of the Almika Group, and he has some great information to share about life insurance retirement plans called LERPs, I guess. And I have a few questions for him. If anyone on Facebook has questions, please chat in the group, but I'm going to post this for later. So my questions are, if you can give a quick overview of what is a LERP and what are possible suggested methods for how to fund those, any effects of having these LERPs on their other retirement assets, how does one get coverage, what are the guidelines for how much a person can get, what that depends on, what's the process that you go through to actually get the money in retirement, and then of course any other things that you think people should know if they're considering LERPs.
Okay, so Julie, I would say that's about 5 or 6 questions. My memory's short, so I'll try to remember all the questions. If you want to restate the first question first, what is a LERP? I think that's what was the first question. A LERP stands for Life Insurance Retirement Plan. It is a life insurance contract that we intentionally overfund so that it will build cash value so that you can tap into that later on when you're in retirement. If you think about traditional life insurance, people buy term life insurance and they try to pay the least amount of premium, get the most death benefit. With a LERP, we turn that exactly upside down. We try to minimize the amount of death benefit because that's not what we're using it for. We want to use it as a vehicle to grow money tax-free so that we can pull it out later on in retirement, just like a Roth. So we typically push the death benefit down as low as possible. That is allowed by tax law. And we intentionally overfund. We put more premiums in there than it's required, and the cash value grows through the years. And then you can pull it out later on. And you can pull it out anytime you want. There's 2 different ways to do that. One is by distributions, and the other is by policy loans. We usually recommend policy loans. If you take policy loans, it's not considered income and it's not taxable. And you never have to pay the loans back if you don't want to. They'll simply deduct the loan balance from the death benefit if you never pay the loans back. But it's a way to grow money tax-free in addition to a Roth. See, the problem with Roth to some degree is there are limits as to what you can do. You can only put $7,000 a year into Roth if you're over 50 years old, and only $6,000 if you're under 50. And so, and that's only if you don't make too much money. If you make over, let's say married, filing joint, about $208,000 a year, you can't even fund a LERP, fund a Roth, I'm sorry. You can't put those contributions in there. And you can always convert IRAs to Roths, but you can't fund new money into Roth. So how do you get taxable bucket money, which is monies like in your savings accounts and regular investment accounts? How do you get that into a tax-free environment if you can't put it into a Roth? That's where we utilize these life insurance retirement plans.
I would like to know how people should fund their LERPs. I think I shared with you that someone told me they suggested liquidating their 401k and taking the hit. And you were like, no.
No.
So can we talk about the various ways you think we should fund?
Sure.
LERPs?
The preferable way is with your taxable bucket of money. Each of us have three buckets of money. We have a taxable bucket, a tax-deferred bucket, and a tax-free bucket. The tax-free bucket, of course, are your Roth IRAs, Roth 401ks, and LERPs themselves. Tax-deferred bucket is your 401ks, your IRAs, 403bs, tax-deferred annuities, that sort of thing, qualified annuities. And then in your taxable bucket is your regular savings accounts, investment accounts, brokerage accounts, things like that. That's the bucket we typically use to fund a LERP with. And I get this question from time to time, hey, can I just move my IRA money or 401k money into a LERP? The answer is no. You have to first take it out, pay the taxes, and then use the money to fund the LERP. The LERPs have to be funded with after-tax dollars. So, but the reason why we want to shift money from the taxable bucket into the LERP is because at the end of the day, we're trying to reposition assets to where at some point in time in retirement, a person becomes completely tax-free and they don't have to worry about what happens to tax rates. Once you're tax-free, you don't have to worry about what happens to tax rates. So we have to have a plan for shifting money from the tax-deferred bucket into the tax-free bucket. You do that by Roth conversions. But how do you get taxable bucket money over to the tax-free bucket? That's where you either spend it down or use it to pay the taxes on Roth conversions. And another great use of it is to fund LERPs. So that's what we recommend. I never recommend you taking money out of a 401k and paying a 10% penalty on it to fund a LERP. That's just stupid to pay IRS penalties. There is, however, one provision in the tax code that will allow you to take money out of an IRA prior to 59 and a half. See, if you're not 59 and a half years old yet, and you take money out of a 401k IRA, you're going to have a 10% penalty unless it meets one of the exceptions. You know, there are a couple exceptions for that, but one of the very well unknown exceptions is the Rule 72T. It's a rule that says if you're not 59 and a half yet, and you want to take money out of your IRA, you can do so under Rule 72T and not pay the 10% penalty. That rule, in essence, is what it's doing is it's saying you're telling the IRS that you're wanting to retire early prior to 59 and a half, and you're wanting to start tapping into your retirement account. And they say, okay, we can do that, but if you're going to do that, it's got to look like that you're actually retired and you're drawing that money on a consistent basis. So that's the bottom line rule. You have to, once you start that distribution, you have to continue it for at least 5 years or until you're 59 and a half, whichever is longer. If you do that, then you can take your IRA, start taking distributions out of it, and then you could use that money. You're going to pay taxes, but not the 10% penalty. You can use those monies to then fund the LERP if that's what you want to do. I actually had 3 or 4 clients doing that. They came to me in their early 50s, and they are very concerned, like I am, about raising, about tax rates going up significantly in the future. And so they want to start shifting money now and going ahead and paying taxes at these low tax rates that we have. And historically, we're in a very low tax rate history right now, period right now. So they want to start shifting money now. And that's how you do it. They did it under Rule 72T. Now, there's an exact calculation for this deal. And like they say on a lot of those shows, don't try this at home. is exactly true of 72T. There's an exact calculation that has to be done. And once you do it, you got to keep doing it. You can't add any new money to the IRA while you're doing it. You can't take any additional amount out. You have to keep doing this amount for at least 5 years or 59.5, whichever is longer. But that's one way to fund the LERP. If you're somebody who's got a lot of money in IRAs and you're younger and you're concerned about tax rates going up a lot. All right, got more questions there?
Okay, thank you, Mike. There's a little bit of a delay between what I hear on Facebook, so that's why I was still listening and I knew you would stop talking. Thank you for that about the different tax buckets. I hope everyone got that. There's a tax-free bucket, which is the strategy he's talking about with the LERPs. There's the tax-deferred buckets, which most of us already know about, the 401ks and the IRAs. And then there's the taxable buckets where your savings are. So I've talked about the importance of accumulating money. You need to accumulate money so you can take advantage of this LERP. Once you do, you mentioned there were some guidelines to me once before. You can't just run in and say, I want a $15 million death benefit with a major cash value. Can you give me a little feedback on what sort of guidelines there are for what benefits and cash values you can get and grow?
Okay. So in the life insurance industry, there's a couple of general rules of thumb. Number one, you can't insure anybody you want just because you want to maybe profit off of their death down the road. That's kind of a morbid thought, but that life insurance industry is not into giving people windfalls of profits. So there has to be an insurable interest there. Somebody's got to be dependent on your income before you even get life insurance on yourself, okay? On them, I'm sorry. So the second thing is that there's got to be a reasonableness to the amount of life insurance. For instance, the examples I typically use is you can't, a person who, let's say, is working at the cashier checkout stand at Home Depot, who's making $15, $20 an hour, can't go out and get a $2 million death benefit policy. There's no insurance company is going to write that. Usually there's a general limit of 10 to 15 times your annual earnings. So if you're making, let's say, $50,000 a year, you might be able to get $500,000 to $750,000, somewhere in that range of a death benefit. So there are some limits regarding death benefit face values, okay? Now, again, as I mentioned on the LERP, we intentionally try to reduce the death benefit down as low as possible, okay? And the reason why that is because if we're using the LERP for purposes of tax-free income in retirement, which that's the whole reason why we're doing it. That's why we call it the life insurance retirement plan. It's a part of your retirement plan, money you're going to live off of, and we want to live off of it tax-free. So if you're going to do that, then we want to use the life insurance we want to maximize, we want to leverage it as much as possible. So that means we want the least amount of life insurance component in there. If you think about it logically, if you were to buy a typical term policy or whole life policy, there's a premium associated with that death benefit. So let's say you were to buy a $200,000 death benefit, there'd be a premium. Let's say that premium was $400 a month. Well, if you just pay $400 a month, then you're going to have that death benefit. And when you die, somebody's going to get the $200,000. And there's not going to be much, if any, cash value built up in it. Of course, there won't be any cash value if it's a term life insurance policy, but there'd be very little cash value with whole life policies. The money you're paying in there is basically paying for the death benefit. But with a LERP, we're intentionally overfunding it. We're not just putting $400 in. We may be putting $1,000 or $2,000 or $5,000 a month. I've got some clients I got one guy putting in $100,000 a year into his. The life insurance certainly doesn't cost $100,000 a year. It's a very small component of it. So the idea is we want to put the most money we can into it and get the least death benefit, because the death benefit costs money. So if you think about it, if you got a very low death benefit, then very little of the money that you're putting in is paying for the death benefit, which is the cost for the life insurance. Most of the money is going to the cash value buildup column account. And that's what you're going to be pulling off of later on in retirement tax-free. So that's why we do it that way. We try to maximize the cash value growth of the policy.
Thank you for your patience with my technological differences or difficulties here. So is there a limit to how much of that they can pay each year? I know there's a limit to the death benefit. Is there a limit to the rest of it that they can put away to grow the cash value?
Well, okay, so when you get a policy, when you first start a policy, there's an illustration that comes with the policy that says, okay, here's your illustration. This is the planned premium amount. Let's say the planned premium amount is $20,000 a year for 7 years. It's typically what I see, $20,000 to $30,000 per year is a typical policy. Once you start that policy in place, that's the most you can do. I mean, you can, like I said, I already talked about you can get a lot of death benefit up to 10 to 15 times, but in a LERP situation, we're trying to put down the least amount of death benefit as possible. The typical policy I see might have $400,000 worth of a death benefit is what I typically see. People putting in $20,000 to $30,000 a year. That's a typical policy. And once you start that policy in force, that's the most you can put in, whatever that premium is. You can skip a payment. You're not committed to it. But if you do skip a payment, then you would make that up. You can make that up the following year, but you cannot get ahead of the accumulated schedule. So if every year your policy said to put in $30,000 per year, then after, let's say you went 2 years, you did 30, and then you did 30 again. And then the third year you ran into some cash flow issues. You didn't want to put money in, so you don't have to. The fourth year, you can come back and make it up. You can catch up, put 60 in to catch up, but you can't put more than 60 in that fourth year because then you'd be getting ahead of the accumulation schedule. So that's how that works. Now, if you said, well, but I'd like to put more money. I came into a lot of extra money. I want to put more money into it. Well, again, you can't. Now you could extend how long you do it. Instead of putting in $30,000 per year for 7 years, you could go 10 years or 15 years, or you could take out a second LERP policy with a different company, or maybe even the same company, a second contract if you wanted to put more money in now.
You actually predicted the next question I was going to ask. What if you get that lump sum of money? How can you do that? But thank you for
Mm-hmm.
You actually predicted the next question I was going to ask. Shut that up. Okay, so the next question I have is, once you've funded your LERP and it's time to start taking those payments, what is that process like?
Well, you simply just call the life insurance company and say, I would like to take out some money. And they'll, of course, ask you how much, and they'll send you what you want. Now, typically, what we recommend is that you don't start taking money out of the policy for usually at least 10 years. But I usually try to run these illustrations to show 12 to 15 years before you start pulling money out. So the ideal situation is you put money in for, say, 7 years on average, maybe from your 60 to 67, say you're 60 years old or 58 or something like that. And then you don't touch it for another 5 or 6, 7 years until you're 72 to 75 in that range. Then you start pulling money out, a supplemental tax-free income in retirement. Now, you never have to take this money out if you don't want to. If you take the money out as a policy loan, the way the insurance companies do it, the way the ones that we use do it, is that you're taking a policy loan out and they're charging you interest on that, typically 4 or 5%, but you're not really taking the money out of the policy. In fact, what's happening is the life insurance company is giving you their money. They're loaning you their money. You're not taking your money out. They're loaning you their money, and your money still stays in the policy earning interest according to the index crediting methods, which is something we probably should talk about how that works. But you're earning money, so you might be borrowing the money out of from the insurance company at 4 or 5%, but you're still making 6 or 7 or 8% from the index crediting method. So there's a spread. It's called positive arbitrage, and that's typically what you see in these policies. And so it's a way for you to kind of be your own banker. You're making money off of borrowing money from the insurance company, but you're still making a little bit more because your money's still in the market. That's typically what we see. But you can start these policy loans anytime you want. You don't have to continue them. You can actually pay them back if you want to. But as you pull this money out, your death benefit will go down. The reason why it goes down is because the company is assuming that you're going to not pay these loans back and they're going to deduct it from your death benefit later on. Now, if you want to preserve the death benefit, then you simply don't take the money out. You'll pass on a really large tax-free death benefit because that thing will continue to grow. One other little side note, I I tell people about on these policies. You can use it for long-term care. A lot of these companies have a critical illness type rider on these policies, or chronic illness type rider, where if you cannot perform 2 of the 6 ADLs, you can tap into the death benefit early, so that you can use it for long-term care expenses, which is really cool, because if you think about it, most people understand that you cannot get your death benefit before you die, because you have to die and somebody else gets the benefit. Where here you get the benefit if you run into a long-term care situation. And a lot of companies, they don't charge, there's not a premium charge for this benefit. They only charge you when and if you need the money. In other words, when they start giving you money from your death benefit, they'll discount it a little bit, and that discount is their fee at that time. But if you've never used it, you never paid for something. That's traditionally the problem with long-term care insurance, is because people pay for a long-term care life insurance, long-term care policy, and they never use it, and they paid all those premiums all those years. And that's number one reason why people don't get the long-term care, although they've got a gigantic concern about it. So we use these policies as kind of a way to cover that risk as well.
Okay, thank you very much for that. You mentioned positive arbitrage and critical illness. I'm definitely going to want to have people, if they wish, know more about that. Would you be able to share your contact information in the chat, which will be shared also on Facebook? Or if it's your signature from your email, I can copy it, but whichever is easier, I would like for that to be shared so that people can contact you.
I can do that if I can figure out how to do it.
I'm sorry, I can't hear you, but real quick.
No, I'm sorry.
What information should they have available so that you can have a good appointment with them? What all of their personal information should they have available for you, given to you before they make the appointment, so the appointment is impactful?
Well, I would say usually when I sit down with people the first time, we just have a general chat. You know, they might bring some of their documents with them, a general. Can you write it down on a piece of paper? This is kind of what I have. You know, to see if they'd even be a candidate for a LERP situation. Some people are not candidates because either they have too many health issues, which is something we could, this is medically underwritten, so you have to qualify for it, of course. We could have that discussion. But also, I'd like to kind of get an idea of how much money they have in each bucket: taxable, tax deferred, tax free. And I don't necessarily have to have account statements on the first meeting. If I just get an idea, I've got this much in my IRA, I got that much in the 401k, I have this annuity, that annuity, I got a Roth over here, I got an investment account. If I can kind of get a visual picture of what that looks like. I have a whiteboard that I've created that has 3 buckets, and I usually whiteboard it first, just see how much money do we have in each kind of bucket, and that gives me a lot of ideas about whether or not they might be even a candidate for a LERP. Okay, and if they are and they've got decent health, then that's something we can certainly go forward with. Now, long story short, if we move forward with an actual putting together an illustration or a plan, I have a tax-free roadmap plan I can put together for them. I don't charge for this. You know, obviously I have to make money somehow, but the way I do it is if people become clients of mine. In other words, if they end up wanting to purchase a LERP or annuities for that matter. I'm also securities licensed, so I do a lot of investments for people. I'm a CPA and I'm a mortgage broker too. So I got lots of different ways to work with people. So I don't usually feel a need to have to charge any fees up front, planning fees or otherwise. There's several ways, you know, that I can engage with people if they need help in any of those areas. So if it comes back and we do a LERP and people want one of those, you know, I get paid a commission by the insurance company if we do a LERP. I get paid a commission by the annuity companies if we end up doing annuities. Now, managed money, that's a management fee. I get paid management fees from the client to manage money. And that's a whole different program platform I could talk to you about at some point. But mortgages, you know, those are handled differently. So I don't have to charge planning fees because I make plenty of money doing the other stuff once people become clients of mine. So, and not everybody becomes a client. You know, I've done lots of plans and estimates and calculations for people, and you know, we part friends. There's just no business done there. Maybe not now, maybe down the road, and that's fine too. That's just part of doing business. So, but you wanted my contact information, I believe. I'll go ahead and put something in the chat here. My main website is almigagroup.com. But he wanted my phone number 972-964-5100, and group.com. I would say right now, if people are interested in talking to me about any of this, let's, if you don't mind, hold off until after April 18th, because I'm buried in tax returns right now. But I'll be glad to meet and talk with anybody after the 18th about these subjects. The best way to do that is you can call my office and talk to Brielle at the front desk, and she can send people my calendar link, and they can book themselves, but after the 18th. So.
Okay, thank you very much. Hope we don't have the feedback one. One last question. What's a good age to start looking into LERPs? I'm already 57. Have I missed the window?
No, in fact, you're right in the sweet spot, as they say. I would say the sweet spot would be probably 57-ish to about 62, probably in those 5 years or so. Now I've got several clients that are over 62 that have done these LERPs, and that's not too late. Usually by 70 is pretty late at that point. But so I would say the sweet spot is 57 to 62, and before that is fine too. Like I said, before that, I've got several clients that are 52, 54, and 55 years old that have done these LERPs. So certainly over 50 would be people would want to start looking at these.
Okay, thank you. I'll have to re-listen to all of this because I have actually missed some of it due to the delayed volume. Is there anything else you'd care to share or would like for people to know? I don't want to really go over our time, and I really appreciate your coming on for this in the middle of tax season.
Well, I'll just say this, that, you know, LERPs have been around for a long time. People think maybe a lot of your listeners may have never heard of this concept before, but the reality is it's been around since the 70s and the 80s, believe it or not. In fact, what happened, I'll give you a little history lesson on this deal. What happened was, way back in the day, back in the late 70s and 80s, a lot of rich doctors started abusing this product, because back then they could dump millions of dollars into these type of policies and only buy very little life insurance, like $10,000 death benefits. They didn't really want the life insurance. They wanted the vehicle to grow the money tax-free. And so this has been around since the late 70s, okay? Well, Congress and IRS finally caught up to that and said, hey, wait a minute, you're using this more as a tax-free investment. And remember, this was before Roths were around, so there wasn't such thing as a tax-free investment back in those days. They caught on to that and said, we're going to have to put some limits to this deal. So back in 1984 and 1988, there were 2 rounds of legislation that came out to put a limit on this stuff. And that's what's been happening ever since then. We've had these limits on it. There's some certain guidelines and tests. That's what I mentioned to you when I said to you earlier, we do the illustrations and there's a certain premium that you put in. And let's just say it's $30,000 a year. And you say, well, why can't I put in more money? Why won't they take more money? It's because of these laws that got enacted back in the 80s. There's a corridor test, a guideline premium test, and cash value accumulation test. These tests are run. And when these things are set up, when you do the policy initially, you can't overfund. You can overfund a policy, but you can't overfund it. There's a limit. Once you go overfund it, once you overfund it too much, it turns the policy into what's called a MEC, a modified endowment contract, which when that happens, that means it loses all the tax-free benefits of the whole reason why we're doing it in the first place. So you don't want to turn it into a MEC. So, but this whole concept's been around since the 80s, and they put some limits on it now, but most people, it's still a very, very, very good tax-free investment opportunity for people, because people are looking for ways in this environment we're in this country right now, with Social Security and Medicare being broke and about to be broke, even broker in the next couple of years. And by 2030, 2033, there's a lot of projections that we're going to be running out of money for those sort of things. And then we got $30 trillion in debt. Everybody's expecting the tax rates to go up significantly in the future. Why do we want to, if you think about it a second, why do we want to keep kicking the can down the road by putting more and more and more money in the tax deferred bucket, it's only going to get bigger. And when they increase the tax rates on us, about the time you take it out, all of a sudden you weren't expecting that. See, we've all been under the condition all our life. We've been told and taught that it's best to put money away on a tax deferred basis, because after all, you're going to be in a lower tax bracket when you retire, right? That's what we've all been told. But the reality is that's not necessarily true. Many of us are going to be in the same tax bracket, if not a lot higher going forward. So if that's going to be a possibility, why do I want to keep pushing money into the future? It's going to be at a higher tax bracket. I'd rather pay my tax now at these historical low rates. Think about it. We got the lowest rates ever right now. We do. And they're going to still be that way for the next 4 years and possibly longer. We should, in my opinion, try to get everything in the tax-free zone as much as we can, so that way, if and when tax rates go up significantly, I don't have to worry about that anymore. So that's those are the kind of big takeaways I want to get across everybody. Why we even use LERPs in the first place. They're not just for life insurance or whole life insurance or permanent life insurance. Is not just for a death benefit. You can use it for estate planning as well as tax-free retirement planning.
Well, thank you very much. I appreciate it. Shamira, there are any questions on Facebook? Or I don't think there are. Let's see.
No,
I don't
there
see.
aren't
Nope.
any.
Anyway, Mike, thank you so much. I appreciate your sharing this information. We're going to put this in the group, and we'll probably talk a little bit more about it. So hopefully you'll get another client or two. Again, thank you so much. Thank you for your time on this busy weekend, and I appreciate it.
All right. Thank you.
Have a good one, and happy Easter.
You too. Bye-bye.
Bye-bye.